Hi, it's Nero here from Investment Rise, and today I want to talk about what I see happening in the property market going forwards. Now, if you've been following my work, you know that over the last few months I've been constantly debating and questioning all these so-called doomsday market predictions from various so-called gurus. And in fact, last week I spoke about how CBA have completely backtracked on those ridiculous, attention-grabbing headlines where in March and April they said the property market would drop by 30% in a worst case scenario, but more likely close to 10%. Well, now they've dropped it back to expecting the prices to drop by 6%, with many markets having already experienced most of that reduction. And now, today we see Westpac come out with their predictions for the market, and even they say, oh yes, back in March, April, we expected the property market to drop between 10 to 13%. But we've been totally surprised by how resilient the market is, so now we're changing our predictions. Look, the fact of the matter is, guys, that the way banks are changing their market predictions, and you're going to see more and more people, I expect, change what they said from 6 months ago to now. None of that surprises me, because the data has always shown that our Australian property market is very resilient. I've spoken about how in GFC and in the recession we had to have back in the 90s, our property markets were resilient. I've spoken about how we had our biggest price correction between 2017 to 2019 when there was no recession, no nothing. It was driven purely by banks applying significant lending restrictions as a result of some APRA initiatives, shall we say. And so the fact is the data was always showing that we have record low interest rates. We have significant record low, approvals on new dwellings, especially in the housing market. We now have lots of stimulus from the government in terms of trying to create jobs, so they're looking to give businesses various tax exemptions to bring on new jobs. We've got banks helping out with offering mortgage holidays, and then there was this whole thing about, oh look, but that's only until September, and then when September comes, we're going to have this fiscal cliff, and the economy is going to fall off the cliff, and everything's going to go pear-shaped. But what happened? Well, banks just came out and said we're going to extend mortgage holidays now until March, and mind you, I expect the banks will continue to extend these mortgage holidays until the economy starts to improve again. So you're not going to see as many distressed sales as you might have and logically expect them. Look, don't get me wrong. It was very easy to expect the property prices would crash. After all, we have record high levels of debt in Australia. The rate of growth of debt has far outstripped wage growth. Rental yields in our biggest cities have dropped. And so it was very easy to expect that, okay, now with COVID-19 and the impact on our economy, property prices would crash. But the fact is they haven't. And now we've got Bill Evans, economist from Westpac, coming out and expecting that between sort of now and June, prices will be maybe a little rocky. You'll see some markets drop slightly. Yes, Melbourne will bear the biggest brunt of that. No doubt about that. I don't think anyone really disagree with that. However, even parts of Sydney are starting to show that they are past their bottom and they're starting to rise. He's even come out and said that he's expecting prices to rise by 14% in Sydney, 18% in Perth, and Brisbane by 20%. And mind you, this is just average that he's expecting. So some areas will perform even better than that. And what's driving this growth? Well, as I said, record low interest rates, undersupply in many areas. I think that once you see the borders officially open up completely in Queensland, you'll see domestic migration start again, and you'll see that market really take off. I think the growth in Sydney is certainly coming, and Melbourne, but we'll need to wait until international migration comes, when that could be dependent obviously on whether a vaccine for COVID-19 is actually going to come in 2021 or not. But the fact is, the worst, I believe, is behind us. And The data is showing that. We're seeing many, economists and so-called other gurus come out and say that, look, yeah, we might have got a tad wrong. We panicked back in March, April. The Australian property market is actually being far more robust, far more resilient than it has been, and than we expected. And so, what would I do if you were looking to buy property right now? I think right now is going to be one of your best buying opportunities, because the market is not rising steeply yet. However, that momentum is building. You've got an opportunity, therefore, to get a good deal right now for sure. You want to get your finances done and approved, so you're ready to move if you see a good deal. And I think also you want to start looking at doing your research, because yes, there is one key factor that you have to be aware of, and that is, as a property investor, the biggest risk to you is whether you can get your property rented. And so there are certain markets I would certainly be avoiding, even despite all this good news. I would be avoiding the off the plan unit market for sure. I would be avoiding any areas where there's already a high vacancy rate. It will reduce, but when, and how long will it take for the vacancy rate to tighten up again? When will rent start to rise in those markets? So I would certainly avoid those markets with high vacancy factors. I would look to avoid any market where you see that's oversupplied. And how do you know if it's oversupplied? Well, look at the time on market. How long is it taking for properties to sell? And is that time on market, is it reducing or is it increasing? Because if the time on market for a property, for how long it takes for a property to sell, if that time period is reducing, then you know that you've got additional and surplus demand. And they're the kind of markets you want to look at. But on the flip side, if the time on market for an average property in the areas that you're targeting is actually increasing, then it shows that it probably isn't time right now to look at those markets. You either postpone when you look to buy a property if you're really attached to a particular area, or you look at other areas, right? So certainly do your due diligence looking at the average time on market, look at the trends, because that will give you a very good idea of whether there's excess demand or excess supply. Combine that with looking at markets that have a very tight vacancy factor, so definitely under 3%, preferably if you can under 2.5%. And if you can combine those two factors, and I think that you will start looking at this being the time period where you can get your best buying opportunities. There are some great deals to be had. I'm not talking about, looking at a huge discount, no, but what I am talking about is getting property at prices today that are less than what they'll be in 12 months time, 18 months time, certainly 2 and 3 years at a time and longer. So yes, I think it's a great time to start looking at property, do your due diligence, and certainly expect more and more of the banks, more and more of the economists and many of the other so-called gurus out there to come out and revise their price predictions for property upwards.
Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.